Financial accounting is fundamental to the success and transparency of businesses. In essence, financial accounting is the lens through which we gain insights into a company's economic health. By definition, financial accounting is a specialized branch of accounting that focuses on preparation, analysis, and reporting of financial information for external users such as investors, creditors, regulators, and other stakeholders. Its primary goal is to provide accurate and transparent financial information about a business entity's performance and financial position. The financial accounting is basically guided by accounting principles and accounting standards. These principles and standards provide a framework for financial accountants to record, report, and analyze financial transactions in a consistent and transparent manner. Accounting concepts are fundamental principles that form the basis for financial accounting practices. These concepts guide accountants in recording, reporting, and interpreting financial transactions. Understanding these concepts is crucial for maintaining consistency, accuracy, and transparency in financial reporting. Let us delve into each accounting concept in detail. Separate entity concept. The entity concept asserts that a business is a separate economic entity from its owners or any other business. This principle emphasizes the distinction between the financial transaction of the business and the personal transaction of its owners. As a result, financial records should only capture activities related to the business entity. Going concern concept. The going concern concept assumes that a business will continue its operations for the foreseeable future. This concept underlines the preparation of financial statements, assuming that the business will not liquidate in the near future. It allows accountants to depreciate long term assets over their useful life and allocate revenues and expenses over time. Money measurement concept states that accounting only records transactions that can be expressed in monetary terms. This concept facilitates the quantification and measurement of financial transactions, making them comparable and suitable for inclusion in financial statements. Cost concept. The cost concept, also known as the historical cost, dictates that assets should be recorded at their original acquisition cost. This concept provides objectivity and reliability to financial statements by avoiding any subjectivity that might arise if assets were recorded at their current market value. Dual aspect concept, or known as double entry accounting. The dual aspect concept is the foundation of double entry accounting. It states that every transaction has dual effects, a debit and a credit. This ensures that the accounting equation, that is, assets is equals liabilities plus equity, remains in balance. For example, when a company makes a sale, it records both the increase in revenue and increase in accounts receivable as well. Matching concept. The matching concept stipulates that expenses should be matched with the revenues they have generated during a specific accounting period. This ensures that the income statement accurately reflects the profitability of the business during a given time frame. For example, costs associated with producing goods sold during the period should be matched against the corresponding revenue from selling those goods. The accrual concept asserts that transactions should be recorded when they are incurred, not necessarily when the cash is exchanged. This concept aligns with the economic substance of transaction, providing a more accurate representation of a company's financial performance and position. Consistency concept. The consistency concept requires that once an accounting method or principle is chosen, it should be consistently applied from one accounting period to the next. Consistency enhances comparability and allows user to make meaningful comparison between different periods. The materiality concept suggests that accountants should focus on the materiality of the transactions. when preparing financial statements. Materiality is based on the significance or impact of a transaction on the financial statement. Transactions that are immaterial need not to be counted for in detail. Prudence concept. The prudence concept, also known as conservatism, suggests that when faced with uncertainty, accountants should err on the side of caution. This means recognizing potential losses and liabilities immediately, but only recognizing gains when they are realized. Prudence ensures a more conservative and realistic portrayal of a company's financial position. Periodicity concept. The periodicity concept divides the economic life of a business into discrete time periods for the purpose of financial reporting. Companies typically prepare financial statements at regular intervals, such as quarterly or annually, to provide information to the users. Realization concept. The realization concept states that revenue should be recognized when it is realized or realizable and when it can be measured with reliability. This concept is particularly relevant in industries where revenue recognition is tied with the completion of a service or the delivery of goods. Objectivity concept Objectivity concept requires that financial information be supported by objective evidence. This means that financial transactions should be verifiable and based on reliable data, reducing the risk of bias or subjectivity in financial reporting. Full disclosure concept. The full disclosure concept mandates that all material information relevant to users of financial statements should be disclosed. This includes detailed footnotes or supplementary materials, providing a comprehensive understanding of the financial position and performance of business. Consolidation concept. The consolidation concept applies in the context of group accounting, where a company may have subsidiaries. It requires the consolidation of financial statements, combining the financial results and position of the parent company and its subsidiaries to present a holistic view of the entire group. To summarize, we can say that these accounting concepts collectively form the framework that govern financial accounting practices. Each concept contribute to the reliability, relevance, and comparability of financial information, ensuring that financial statements accurately reflect the economic reality of a business and support informed decision making by stakeholders. In accounting standards, there are basically two different streams that are currently being followed in the world. The first one is International Financial Reporting Standards. International Financial Reporting Standards is a set of global accounting standards developed by the International Accounting Standard Board. It is widely used in many countries around the world, promoting consistency and comparability in financial reporting. The second one is Generally Accepted Accounting Principles, also known as GAAPs. GAAP in the United States refers to a set of accounting principles, standards, and procedures established by the Financial Accounting Standard Boards. It serves as the foundation for financial reporting by the companies in the United States. Role of accounting principle and standards in financial accounting. The very first is the provision of consistency and comparability. Accounting principles and standards such as GAAPs and IFRS promote consistency in financial reporting. Consistency ensures the similar transactions are treated in the same way across different periods, enhancing comparability. The second one is transparency and trust. Following established accounting principles and standards foster transparency in financial reporting. This transparency builds trust among stakeholders, including investors, creditors, and regulators, as they can rely on standardized information for decision making. Then, global comparison. The adoption of international accounting standards such as IFRS facilitate global comparison of financial statements. Companies using the same set of standards can be more easily compared, promoting international investment and financial analysis. Finally, the regulatory compliances. Companies are often required to adhere to specific accounting principles and standards to comply with regulatory requirements. This ensures that financial statements meet legal and regulatory expectations. Now, finally, we will look at the accounting process. The whole accounting process involves a series of systematic steps that financial professionals follow to record, analyze, and report financial transactions of a business. This process is crucial for producing accurate and reliable financial information that helps stakeholders make informed decisions. The accounting process typically includes the following steps. The first one is identifying the transaction. Accounting process begins with the identification of financial transaction. Transaction include sale, purchase, expenses, investment, loans, and any other activity that involve the exchange of economic value. Then these transactions are recorded. Once transactions are identified, they are recorded in accounting system. This involves using a system of debit and credits to enter the transaction into the appropriate accounts. The most commonly method is double entry bookkeeping, which ensures that accounting equation assets is equals to liability plus equity remains in balance. After recording the transaction, it comes to journalizing. Transactions are initially recorded in a chronological order in a journal. The journals serve as a book of original entry, capturing the details of each transaction, including accounts affected, amounts, and dates. Posting to ledgers. The information from journal entry is then posted to the general ledger. The general ledger is a collection of individual accounts, each representing a specific asset, liability, equity, revenue, or expenses. Posting ensures that balance of individual accounts are up to date. A trial balance is prepared to ensure that total debits equals total credits after posting entries to the ledger. It provides a preliminary check on the accuracy of accounting records before moving on to the preparation of financial statements. Adjusting entries. After trial balance, there are certain adjusting entries that are to be made at the end of the accounting period to account for transactions that occurred but were not recorded in general ledger. These entries adjust accounts for accrued revenue or expenses, prepayments, depreciation, and other adjustments necessary for accurate financial reporting. After passing adjusting entries, adjusted trial balance is prepared. The trial balance reflects the adjusted account balances and is used as a basis for the preparation of financial statements. The adjusted trial balance is used to prepare the financial statements, which typically include the income statement, balance sheet, statement of cash flow, statement of changes in equity, and also the notes to the accounts. At the end of the accounting period, closing entries are made to reset temporary accounts, revenue, and expenses to zero. This process ensures that next accounting period starts with accurate revenue and expense account. Post closing trial balance. After closing entries are made, a post closing trial balance is prepared to verify that all temporary accounts have been closed and that only permanent accounts remains open. Reporting and analysis. The finalized financial statements are distributed to internal and external stakeholders. Financial analysts and decision makers use these statements to assess the company's financial performance, position, and viability. And finally, the auditing. In many cases, external auditors review the financial statements to provide an independent assessment of their accuracy and compliance with accounting standards and principles. To conclude, financial accounting is the lens through which we gain insight into a company's economic health. It encapsulates the principles of accuracy, transparency, and accountability through the meticulous application of generally accepted accounting principles and accounting standards. Financial accountants ensure that financial statements reflect not just the economic reality of today but also pave the way for sustainable and thriving future. If you guys have any comment, any questions, all of them will be entertained. And please don't forget to follow the channel for more updates on accounting and its related practices.